Now we get to turn to Asia. So I had to take a quick break to do a podcast with Michael Gayad. It was on Twitter. Feel free to check it out. The recording is going to be available in the next few hours. Obviously, you'll by the time you're watching this, it'll be available if you're bored. And it's something that we're going to talk more again next week when we look at the food side. So now we want to turn to China. And here you can see the China manufacturing PMI was expected at 50.1, came in at 50.1. And it's important to look at, this is normally where it comes back to following a reopening. And that's why we don't see the next leg being much better at this point, just because there's so many other issues that remain for the Chinese economy. We are by no means saying it goes back to 47 because, again, we're not going to have another shutdown. It's just going to be a matter of, does it go to 50.5? Does it go to 49.5? And I think that the next iteration could really go in either direction, with the likely kind of just holding in at a fairly firm level. Now, the non-manufacturing side had that nice spike from, it was expected to be at 52, came in at 54.4 because people, they couldn't buy stuff. They couldn't go out. So there's a certain amount of benefit with some of those activities coming through. But now, what you can see the peaks and then it comes back down. We think that things kind of settle and come closer towards, on both ends, towards the 50, still going to be expanding, but just not to the degree I think people are this hopeful, where there's all this pent up demand. We don't see this huge pent-up demand. So on Tuesday, Xi gave his annual speech at the Central Party School to all newly elected Central Committee members. And this is important because it's essentially his State of the Union address. And what he called is the Chinese-style modernization. So how he describes it, it's necessary not only to create higher efficiency than capitalism, but also to maintain social equity more effectively. So he continues to double down on the socialist, capitalist, communist kind of juncture of having the state be very involved, but still try to let market forces have a certain amount of movement. So this is the first time Xi has publicly discussed the idea of creating higher efficiency than capitalism. So he's setting the stage for what we think is going to become a more pronounced thing going forward of the new school of thought. And what does that mean? The fact that he said it in such a high-profile setting is important, but China's total factor productivity is currently about 40% of the American level. So how are they going to be able to compete as we get some of these shifts? Xi is very clearly positioning the Chinese system as something that is in competition with capitalism, but a more state-dominated economy is not going to be more efficient. And that's where we see the crux of the problem, because they're trying to create, their semblance of equality. They're trying to create the dual, the dual mandate, trying to create some of this movement and bring people up on this level. But they're also putting new CCP officials into private companies, but yet they want more entrepreneurship, but they want more oversight. And everything seems to be at conflict, which is why we think that there's going to be this problem of, well, how much are people really going to want to invest additional in China? Where is the FDI going to come from? Or has that since passed? And now they're going to have to try to stand on their own 2 feet, which we think is going to be a problem given the level of losses people have taken. Now, when we look at the level of Chinese employment, you can see the bounce coming off of obviously the low but it's still contracting. And when you go back through time, you can see it has been contracting for several years, which is why we see, again, this pervasive slowdown and problem in terms of spending. So the migration index above previous years, so you can still see that people have been more mobile during this past Lunar New Year versus previous, but not all of it was for travel. Some people stayed local. So there is a certain amount of variability, as we've shown in the EIA show and as we're going to show again next week, where even though there was more mobility, there was still below last year's consumption and 2019's consumption of fuels. So now when we look at the CAIXIN Chinese service PMI, expectation was for 51, came in at 52.9. there's going to be that, again, that bounce where you get the bounce, but it doesn't mean it's going to continue. And that's where we continue to see some of these slowdowns. Business expectations are obviously much better. That's not a surprise. It's just we see a lot of this normalizing, especially after we come from Lunar New Year. People are now coming back down to normal, so trying to find some sort of balance. And that's, again, going to pull down. And as people don't have as much money to spend, we think after this initial shock, you get a little bit of a cool down as people now just try to find their new normal. Now, Beijing also laid out a roadmap to improve product quality, because it's not a surprise. And as we've been saying, they don't just export the bad stuff abroad. They also have locals that don't like their product, that have a quality issue, which creates a bigger problem because nobody wants to buy Chinese products. Everyone's concerned about the quality of it. So the outline sets targets to measure quality improvements by the end of 2025, including a continued rise in the manufacturing quality competitive index and product qualification ratio. But that increases cost. So again, there's always this back and forth of how do they manage inflation while trying to manage cost, and that's that back and forth that's continuous. China foreign exchange reserves bounced. That is a benefit of some of the additional exports, which have since slowed. So again, we do see some of that back and forth, and it came in, but we don't see a big explosion higher, just kind of walking within this fine line. The credit impulse provides a gauge for longer-term sustainability, but we're not seeing that cycle. And that's where we continue to see this problem, especially because there's not a single local government that achieved their GDP goals, and they don't have the ability to get additional revenue. They can't buy, as the real estate market shut down, as the land market isn't there, they have no ability to go out there and try to harvest more revenue because they've issued a ton of tax cuts, a ton of incentives, and that continues to provide an overhang. And this gives you an idea of the valuation of different asset classes in 2017 by country. China housing, when you look at how housing was so it puts into context how pivotal housing is versus the US, versus Japan. And this is why so many people are so overly exposed that this huge write down, this huge move down creates this lasting impact that most people can't dig out of. They didn't own Chinese stocks or bonds. They were mostly in housing and real estate. And until we get a meaningful move higher, these people are sitting on either paper losses or real losses that will take time to cover. And again, that's impacting local revenue from land sales. As you've seen, land sales impacting, we're down 23.2%. So CAIXIN China manufacturing PMI expected to be at 49.8, came in at 49.2, and new orders were still down. So this is there's obviously the official manufacturing one, the CAIXIN one, and it's telling you the story that things aren't great. They're not terrible. Like, it's not like, this is going to 30, China is gonna growth is gonna be negative 10%. No, it's just the expectation of a 6% growing China is just not realistic. Unless we get a massive bump in exports, we get a global recovery. And based on rates and economics, we're just not there, and we're not really going to get to a point of meaningful growth. Corporate borrowing trends continue to be negative. When you look at January, there is no demand for debt. You can talk about, some of the pent-up demand has increased, but it's not on a meaningful level. When you look at services, retail, and manufacturing, the demand isn't there. Loan applications aren't there. Loan rejections still remain elevated. There is a struggle where people don't have the ability to carry additional leverage, and they're not looking to do so. Revenue growth by sector continued to recover from December, but it's not the same as January 2022. Services are a bit better, but manufacturing is struggling. Retail is not there. And that's with a reopening. Think about January. January was fully reopened. The process started in December. January was there, and we're still not getting the revenue growth that I think people are expecting to get this recovery. Now, when you look at other places within Asia, South Korea business survey manufacturing continues to trend lower, non-manufacturing something similar. You're getting a problem across the board, and not just China. It is a broader Asian slowdown. And typically, again, China buys a lot from South Korea, intermediate goods. These are things that move through. And as you're getting that without a real Chinese bounce, you're going to get that reverberate through the system. We talked about it with Germany in the previous segment, and now here we are with South Korea. India continues to be a bright spot. Things cooled off slightly, but still at showing a lot of growth. But things are running fairly hot. So this is really the last bastion of strength where we think there's a bit more downside. But even if there's downside, you're still in growth. It's just we're saying they're not going to grow as much as some of these reverberating factors show up, because India has been able to weather them so well. And that's where we see some risk, because a lot of the good stuff has been priced in at this point. And this shows you just how things closed out with a bang. Everything, typically December is a good month. It obviously was the best month going back to 2013. So now it's going to be interesting to see how January and February play out, given some of the slowdowns that we've seen in the broader market. Now, taking that back to China, China's credit impulse is hurting economic activity. And even with the movement trying to drive more impulse, we're just not getting there. And that's where we see a lot of these problems, a lot of these hesitancies and inabilities to drive additional growth. And the PBOC doesn't want that. I mean, China has said they will not give straight money to consumers. There is an open concern about giving money to people and having driving inflation, driving inequality. They're trying to avoid that, which again is why they're trying to use all these different avenues, and it's just going to continue to fall flat because everybody is so levered. No one's looking to take additional debt on the corporate side. And then on the personal side, everybody was so levered to real estate, there's no ability to lever again. China province GDP targets and results for 2022, nobody hit targets. I don't think that's crazy to understand given this situation that they're in. But now as revenue continues to fall off, the inability of raising additional taxes, more subsidies being rolled out, you're going to have additional pressure on the government side. Now, Taiwan export orders expected to be down 25%, came in down 23.2%. A little bit of a stabilization, but there's normally a bounce in December when you look at the, over on the USD level. So we still see, again, downside, but not a continuation, just holding in at these levels. It'll be negative. It'll bounce, as you can see, as it did in 2020. But we don't see this huge recovery. Instead, it's really this waffling in this contractionary standpoint because there's so much inventory and because people need to work through what they have. Taiwan exports, the final came in at 21.2, which is worse than the expectation of 20.3. And that's keeping the Taiwan manufacturing PMI, further marked drop in output as demand deteriorates. Selling prices decline for second straight month. And as you can see, things are stabilizing here as we continue to see, and we believe you're going to have a continuous contraction in this region. Now, Japan's labor market is the tightest in years, pushing up wages as the trade balance gets worse. Now, remember, pushing up wages is negative for inflation, going to create more problems, which the BOJ is going to have to address, which is why we think they're going to have to step off of their cap, and you're going to have to see rates really go higher. So wages versus inflation, you get an idea of how they're connected and why the BOJ is going to have to get serious on how will they address the inflationary cycle, because they're going to have to raise rates to try to bring this under control. And the market is essentially challenging them, saying, we know you're going to have to, and they're bumping it right back to that 50 basis point line where they've set their ceiling for that 10-year. They're going to keep pushing, and eventually, given where inflation is, you can see the monthly purchase of government bonds. They continuing to buy, protecting this level. But as inflation goes up, as wages keep going up, they're going to have to yield. And that's why we think that there's going to be a free float, or at least a new ceiling of 75 basis points, if not 1%. South Korea exports saw a similar decline, came in at negative 16.6. Survey was for negative 11.1. So again, you saw some of that continuation. Imports were a little bit better. So we should see some stabilization, but again, still going to be negative. It's just, we're going to see stabilization at a depressed number, which is why we see more economic pain in Q1. South Korea manufacturing PMI, again, stabilizing at that contractionary level. Manufacturing output falls at the sharpest rate since last October. Employment levels increase for the first time as input price inflation eases. Again, just that stabilization in the contracting level. And then Vietnam, for inflation, expected to be at 4.8, came in at 4.9. And it's no surprise to see Vietnamese exports do something similar. Expectation was to be down 10.4%, came in down 21.3%. And that's why when you look at China, when you look at the global trade, we see a lot of headwinds, because and now a lot of the leading indicators that we talked about in the EIA show from freight waves, you're seeing a slowdown in exports. You're seeing a slowdown in what's coming to the U.S., and that's showing up here. And again, that's going to be more pain on emerging markets, more pain on the economy, which is why we think the IMF is still overstating global growth, especially emerging market growth. So that's what we have for you today. If you have any questions, please feel free to reach out. We'd love to hear from you, and we hope you enjoy the rest of your day. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.